On Thursday afternoon, June 11th, BlackRock filed a Form 8A with the SEC. As filings go, it's not dramatic. 2 pages, registering a new fund's shares with the exchange, but it's almost always one of the very last steps a new ETF takes before it begins trading. And in this case, the new fund is something that has not existed in the US spot Bitcoin ETF channel before. The fund is called iShares Bitcoin Premium Income ETF, ticker BITA or BITA. Expected launch Thursday, June 18th. It's worth taking some time to walk through because BITA is structurally different from anything in the spot ETF channel since January 2024. To see why it's different, it helps to back up and look at what the existing channel has been. Since the SEC finally approved spot Bitcoin ETFs in January of 2024, the channel has had one product type. Each of the 13 tracked spot funds, BlackRock's IBIT, Fidelity's FBTC, Grayscale's GPTC, and the smaller ones, does the same thing the same way. The fund holds Bitcoin in custody. The share price tracks Bitcoin's spot price. The fund charges a small management fee. That's the whole product. If Bitcoin goes up 10%, the share price goes up roughly 10%. If Bitcoin goes down 15%, same thing. The wrapper does one job. It gives an ordinary brokerage account a way to be long Bitcoin without holding the keys directly. That single product type grew to roughly $80 billion in assets in the 2 years since launch. A lot of capital came through the door because the door was simple. What BITA does is engineer a different kind of payoff on top of that. It takes the Bitcoin exposure, primarily through shares of BlackRock's own IBIT, the largest of the original spot products at $49 billion, and it adds a layer. The layer is called a covered call. To understand what that layer does, the cleanest way is to walk through an example. Imagine for a minute that you own a small house with an apple tree in the backyard. The tree gives apples every fall, but you don't really know in advance how big the harvest will be. Some years the tree gives you 10 bushels, some years it gives you 40. Now suppose a neighbor comes to you in the spring and offers a deal. They'll pay you $100 right now, in cash. In exchange, they get the right to buy your entire apple harvest in the fall at a fixed price of $30 a bushel, whatever the harvest turns out to be. You think about it. $100 sounds nice. $30 a bushel is roughly what apples have been going for. So you take the deal. The neighbor hands you $100. You hand them a piece of paper. The paper says that they have the right, but not the obligation, to buy your apples at 30 a bushel come October. Now October comes, and one of 3 things has happened. The first is that the harvest is roughly normal, 20 bushels at $30 a bushel, the going rate. The neighbor exercises the right, buys your apples at 30 each, and you walk away with $100 plus $600 from the sale, $700 total. A perfectly fine outcome. The second thing is that there is a freeze in May. The harvest is small, and apples are now selling for $60 a bushel everywhere in the county. Your neighbor still has the right to buy at 30. They still buy. You sell at 30 even though the market price is 60. You keep the original 100. But you watch the rally happen in your own backyard, and you didn't get to participate in it. That's the cost of the cash you took back in spring. The third thing is that the harvest is enormous and the market is flooded, and apples are now $10 a bushel. The neighbor doesn't exercise. No point. They could buy apples cheaper at the market. The deal expires unused. You still have the original 100, but the apples, which you now have to sell yourself, are worth a lot less than you'd hoped. That, in plain English, is a covered call. The apple tree is the underlying asset, the $100 is the option premium, the cash you receive in exchange for selling the right. The $30 per bushel level is the strike price, the price at which the buyer can call your apples away from you. And the deal is covered because you actually own the tree. You're not selling something you don't have. Now, scale that up and replace the apple tree with shares of BlackRock's IBIT, which is itself a wrapper holding Bitcoin in custody. BITA is a fund that holds those IBIT shares and, every month, sells call options against a portion of them. The fund collects the premium income from selling those calls and, after fees, pays it out to BITA shareholders as monthly income. That's the engineering. That's what BITA does, and that's why it exists. So who actually wants this? Well, if you're a person who already holds Bitcoin directly in a wallet with your own keys, BITA isn't really for you. It's not a self-custody product. It's a Wall Street wrapper of a Wall Street wrapper. But Wall Street wrappers exist to solve specific institutional problems. The problem this one solves is real. And that problem is mandate fit. There's a whole class of professional investors that operates under formal legal mandates requiring income from their holdings: pension funds, endowment cash flow sleeves, retirement income mutual funds, balanced fund managers, certain insurance company general accounts. The mandate isn't optional. The fund's prospectus, or the pension's actuarial assumptions, or the insurance filings, they all assume the portfolio kicks off a certain dollar amount of cash every quarter. And under those mandates, holding Bitcoin directly or holding a pure spot ETF like IBIT has been functionally impossible. Pure spot Bitcoin pays no yield. The mandate doesn't permit non-yielding allocations beyond a small cash buffer. So even if the manager wanted Bitcoin exposure, they couldn't take it without breaking the rules. BITA changes that. By engineering monthly cash distributions from the option premium income, BITA becomes a yield-bearing wrapper around a non-yielding asset. And a yield-bearing wrapper is mandate eligible in places that pure spot Bitcoin is not. That's the unlock, and that's exactly what's new about the launch. The price of the unlock is that some of the upside is gone. When Bitcoin rallies sharply through the strike of the sold calls, BITA shareholders give up that piece of the rally. Just like the apple tree owner gave up the rally to $60 a bushel. In flat or modestly up months, BITA shareholders collect the income and don't really notice the cap. In sharp drawdowns, they're largely exposed to the same downside as IBIT. The income offers only a small cushion. So it isn't a free lunch. It's an engineered redistribution of Bitcoin's payoff shape, trading some of the right tail for a steadier middle. Whether that's attractive depends on what you need the money for. So where does this leave the channel as a whole? Two things, mostly. The first is that once BITA begins trading, the US spot Bitcoin ETF channel is no longer one product type, but two. The pure spot wrappers, IBIT, FBTC, GPTC, and the rest, continue to do what they've always done. BITA sits alongside them as a structurally different shape. Goldman Sachs' competing covered call product is expected to follow around the 1st of July. Once the product class exists in the channel, it tends to grow. The equity index version of this engineering, covered call wrappers around the S&P 500 and the Nasdaq 100, has existed since the late 1980s. It's now a well-established segment of the ETF universe. Bitcoin is joining that subsegment. The second thing is the deeper one. The original 2024 spot ETF approval was the moment institutional capital got a regulated way into Bitcoin. The BITA launch is the next order step. Institutional capital with income mandates gets a regulated way into Bitcoin. Each unlock is small on its own. Together, over the long arc, they add up to Bitcoin moving from outside the wrapper into it. That's not a price prediction, mind you. The product launches whether Bitcoin is at 60,000 or 80,000. The structural fact is the news. So, IBIT is the original BlackRock spot Bitcoin ETF from January 2024, a pure spot wrapper that tracks Bitcoin's price. BITA is a separate fund that holds shares of IBIT and writes call options on them to generate monthly income. They're related products from the same issuer, but they behave very differently. IBIT moves from Bitcoin with Bitcoin's price. BITA pays income but caps part of the upside. They are not interchangeable choices, even though the underlying exposure is the same asset. So what yield should someone realistically expect? Well, it's hard to say in advance. The actual yield depends on Bitcoin's volatility month to month. The strike levels BlackRock chooses and the option market's pricing on those strikes. As a rough reference, the existing covered call Bitcoin ETFs, YBTC and BTCI, have advertised headline yields in the high single digits to low double digits annualized. BITA is likely to land somewhere in that band, but the actual realized yield will vary materially with market conditions. The headline number is not a guaranteed payout. Does the Fed's June meeting change any of this? The Fed meets June 16th and 17th, the day before BITA's expected launch. Market odds of a rate hold are around 98%. So the action, if there is any, will be in the forward guidance language rather than the rate decision. Dovish guidance could lift risk assets and improve the day one flow picture. A hawkish surprise could do the opposite. None of that changes BITA's structural design or whether it launches. It changes the noise level around the launch. Does BITA make Bitcoin more like a dividend stock? In a narrow technical sense, sort of. For a holder of BITA, the wrapper produces something that looks like a dividend in the form of monthly distributions. In the deeper sense, no though. The income isn't coming from Bitcoin itself. Bitcoin doesn't pay anyone anything. The income is engineered by selling option premium against the Bitcoin position, and the cost of that engineering is the upside cap. So it isn't the Bitcoin that becomes a yielding asset. It's that there's now a wrapper synthesizing the appearance of yield by giving up some of the upside. That's a very different thing structurally, even if the cash flow looks similar on a brokerage statement. A couple of housekeeping items. The June 13th difficulty adjustment landed on Saturday at minus 10.09%, the second largest downward print of the year. The June 7th piece on this channel had the pre-retarget estimate at minus 9 to minus 10%. The actual landed in that band. The network's feedback loop is doing what it was built to do. Spot ETF flows broke their 13-session outflow streak on Friday with about 86 million in net inflow, the biggest single day in 4 weeks. BlackRock's IBIT was almost 2/3 of that. SpaceX went public on Friday at a $1.7 trillion valuation, the largest IPO ever. That's the same day the Bitcoin bounce off the $60,000 yearly low picked up real conviction. None of those is the lead frame here, but they are the backdrop. Thanks for spending some time with us on this one. Glad you came by. The June 10th piece on this channel walked the House of Ways and Means Committee's first dedicated tax bill hearing in over a decade. That was the federal tax friction layer of the rulebook. This piece walks a different layer of the same broader picture, the institutional product engineering layer at the wrapper level. Both pieces are about how the federally mediated structures around Bitcoin keep slowly moving in small but very durable ways. If you missed the June 10th piece, give it a watch. It's linked in the description. Be well out there, and catch you next time.